Here's the question. How does the conflict in the Ukraine affect the market overall? Now, as of today, when I do this video, we now know that the NASDAQ is down 30% plus. We know the S&P is down 20% plus. We know that the Dow's approaching 20%. Please take notes. We also know that Bitcoin is down about 70% from the all-time high, which I think happened in November. We know that gas is over $5 a barrel. Inflation is at a 40-year high. And during all this time, Joe Biden's fallen off the bike, right? So that is, to me, the epitome of what's happening right now. Sorry if you're a Biden fan. I think the truth is you know the truth. And at the end of the day, we need change. But the change could always start from within. And today, I want my man David Harder.
Hey, what's up, brother?
And we're going to talk about many different things.
Yep.
But let's talk a little bit about how the market is impacted right now, as you see it, Dave, based on what's happening over with the illegal occupation of Russia going into the Ukraine.
I just think it exacerbated an already pre-existing problem. Rob.
So tell us a little bit more so we're on the same page.
So, folks, when all of the conflict started over in the Ukraine, nobody was really, I don't want to say nobody, but I don't think we were necessarily paying as much attention to the fact that debt to GDP in the United States was at about 125%. That's when all of this started, right? We've now gotten out to the point where it's almost 130%, right? 130 times debt to GDP.
So, Dave, do me a favor, because that's such a tremendous bullet.
Yeah.
Can you explain, seriously?
Yeah.
Like, I know it took me a long time to understand debt to GDP.
Yep.
Right? Yep. So, and this is, by the way, this is phenomenal, because I think what you're saying is that we were already on a slippery slope.
Yes.
That Ukraine, Russia began to like turbocharge that.
Yes.
Challenges that may not stop anytime soon.
Correct.
What came in fast could pull out slow. But talk a little bit about what you just said about debt to GDP.
Yeah. So the United States debt is in now, I think it's approximately about $30 trillion.
Can I add value?
Please.
Yeah, it's at $30 trillion.
Yeah.
And remember, it's not Republicans or Democrats.
No.
I'm going to tell you why right now.
Yeah.
When Bush number one,
yep,
late 80s, it was at 900 million. Clinton, Bush 2, Obama, Trump,
yep,
and now Biden, it's been a steady increase over time as they continue to print more and more money. But again,
absolutely
debt to GDP, if you don't mind.
So the United States owes over $30 trillion, and the interest owed on that is about $700 billion, right?
Going.
That doesn't come by itself, right? We're going to end up having to pay for that. The challenge is that traditionally we had offset that with our gross domestic product, right? With what we produce and what we export. We're not doing that any longer, unfortunately.
So we're not exporting goods either.
We're not exporting goods to the level that we once were by any stretch of the imagination.
Wow.
Yeah.
I mean, so like we're not only not exporting, we're importing, printing money, paying higher interest.
Yes.
And at the same time, creating more debt.
Correct. And the conflict,
and then increasing the balance on the credit card.
Correct. And
America's credit card.
And here's one of the big challenges. One of the big challenges is that, that when we did that, right, we already had inflationary pressure ahead of us even prior to all of this. And then COVID took place, and the fact that we have an administration that is looking for green energy, I think is really, really creating a challenge for us, because energy is the primary driver behind what is now massively accelerating inflation, Rob. And when inflation takes place, what's the Federal Reserve supposed to do?
Tell the folks.
They have to raise interest rates. They have to, right?
Why?
Because, you have to raise interest rates because otherwise your dollar, think about this. A year ago, I have heating oil in my home.
Yep.
A year ago, about 150 gallons of home heating oil cost about $450.
Got it.
About a month and a half ago, I got that same 150 gallons, and it cost $900.
100% increase out of pocket.
100% increase out of pocket. My dollar did not do the same today that it could have done a year ago.
And right now, people are paying $5 for gas,
Correct.
an increase in the value of food and clothing.
Correct.
Right?
Correct.
And but now, the great resignation, which had a little bit of teeth, as I understand it now, whether it's Elon Musk, who's going to he's going to let go on all of his companies about 3.5% of his employees. But the top 4 corporations in the world right now are in a hiring freeze.
Yeah.
So now all of a sudden, the people that are sitting on their couch with cheese doodles on their fingertips because they're not working are going to have to find themselves in a position to go get a job.
Such a challenge.
Unfortunately, there's no jobs available.
I know.
Right? Is that kind of what's happening right now?
That's very fair. That's very fair. They might say that it's a great job market, but it depends on which job market that you're looking at.
And I think the biggest export for the Ukraine is bread,
Yep.
which now ties into our farmers, ties into commodities, ties into the supply chain. And at the end of the day, if we look what's happening with China, they're in another version of a lockdown.
Yep.
Right? We also heard when the war started that Russia was going to go out of business. They were bankrupt, this and that. Now, all of a sudden, they've increased their oil outflow 900% to India.
Interesting.
Think about that.
Interesting.
And now everyone's buying oil from India.
And the other part of it, too, is that if we're exporting bread and or these goods and services out to Ukraine or any other country, what does it cost to get there?
No, Ukraine is the one that does it, but they're no longer doing it because of what you're talking about.
And it also requires energy to ship anything anywhere.
Yes.
And that requires oil.
Yes.
It's just the way that it is. So, to help people, the Federal Reserve, and to help the economy not to spiral into a massive recession, the Federal Reserve has had to make the decision to increase interest rates. Well, when things cost more to borrow, companies tighten their pockets. That's what you're talking about with Elon Musk, and markets don't like that.
Yeah, and at the end of the day, myself and Dave are not fiduciaries. We're not giving investment advice. We're speaking from an educational perspective right now. And at the end of the day, what we're looking at is the ability to really educate yourself. And, we had the great Barry James Dyke here recently. And if anyone knows who Barry is, typically inside the industry, people know him. Jack Bogle wrote the foreword to one of his books. Barry blew the whistle on Wall Street back in 2007, a year before the Great Recession happened, where you saw the Dow in 1 year, intra-year, go down 53%, only to end up down 37%. And he spoke about the corruption of the banks. He spoke about the corruption of the financial institutions, as well as the corporations and the government, on how, especially if you look at the financial institutions and the banks, their institutional money was going in one direction, and they would tell their retail clients something completely different, which is really where he calls Wall Street a casino. Where am I going with this? So right now, every single month, you may have been looking at your statements, and those statements may have gone lower. And when you dig deeper into understanding, and don't take my word for it, go grab Barry's book, Pirates of Manhattan. And if anyone wants a copy of the book, send me a private message, ask below. We will make sure that we get you a copy of it, provided you sit down with no obligation with us, and we do a free financial audit. But with that being said, if you want a copy of the book, we'd love to give it to you. And what he talked about is how target date funds, grab a pen, folks, target date funds 3 years ago, they would basically take on about 3% of private equity money. They're now going up to 15%. WeWorks was a company in 2019 that was packaged as a tech company. It was really office furniture company. When they went out of business, it was 110 with a B, $1 billion loss. And this was inside your target date funds. This was inside your 401k. So just because it says low cost doesn't mean low risk. Low cost doesn't mean low risk. And this is about education. So right now, a lot of people say, hey, what should I do with my portfolio? My first response is, I'm not here to offer recommendations on a portfolio, but I'm here to offer questions and strategies to ask questions about when it comes to who your fiduciary is, who your financial planner is. And the question is, hey, how am I doing in my portfolio when it comes to diversified within and amongst not only the portfolio itself, but overall in all my asset classes? And I think that's an important thing. We can't, the market's down so much, we can't solve it overnight.
Right.
But what we can solve is for the right kind of questions to ask that shift your thinking the right way going forward on how to position your money, especially when it comes to being able to save 15, 10, or 20% of your income on a monthly basis, and how that money's consistently and repetitiously deployed no matter what's going on in the market. So you're not riding a roller coaster, but if it's down, you're going to average down, if that's what you do. Or if you want to put it into another safe haven, you could do that, like cash value life insurance, or build up your emergency fund, whatever the case may be. But if you have an economic plan strategy that sits and fits with your core values, that's tied to your investment philosophy, well, guess what? As economic winter is here right now, you're not cold. Go ahead.
Woo. I mean, it's not all doom and gloom out there either, Rob. You're 100% right. I mean, I think that the media would have everybody believe that it's, it's now doomsday, and that there is no place to hide. There's no place to store money. There's no place to, and that's just quite frankly not true. I think that it's such an easy time for people to abandon, to your point, their investment philosophy, if they even have one, quite honestly.
They probably don't.
You mentioned Bitcoin too. I did a video about this the other day. I said, those who are abandoning Bitcoin was down 75% or something like that year to date. But if there's this big exodus coming from Bitcoin, did you belong there in the first place? Did you actually understand what it was that you were buying into? Right? Were you trading it, or did you have a long-term philosophy around it? You probably didn't have any. You probably were just following what everybody else was suggesting that you do. That's a recipe for disaster. That's why you see the trade off the way it probably is, right?
Yeah. Another conversation. Yep. I think to your point, though, you and I had the benefit of knowledge and intellect to see what the internet stocks did in 2000.
Yes.
I think 85% of the companies on the NASDAQ prior to 2000 no longer exist.
That's
right. So I think whether it's because they went out of business or they were actually taken over, the point is the amount of money that was in 401ks that was being deployed in that direction for window dressing purposes so they could tell people that had portfolios that they did have internet stocks was astonishing. And there was so much wealth lost during that process. But, we talk about what it's like to understand what's really happening with money, right? And Barry often spoke about, and what I thought was just brilliant, he talked about how retirement planning is based on one thing, retirement income.
Yep.
Period, end of story.
Yep.
He talked about the importance of guarantees. Now, listen, he owns his own RIA. So he's not saying no market. What he's saying is the importance of contract wealth, the importance of guarantees, and the importance of where annuities fixed and whole life plays into that equation overall, which I thought was amazing.
Yep.
Once again, go ahead, click the link below if you have any questions. We'd love to answer any questions. If you want a free financial audit, David or one of the team members will sit down and take you through the success process. But, back on something that I thought was really powerful, history doesn't repeat itself, but it rhymes.
Yep.
Ted Benna, the guy that created the 401k, right? He created the 401k for one purpose, to build out a platform for employers to be able to set up a profit sharing plan, a defined benefit profit sharing plan. What he created is not what happened afterwards.
Wow. And
the whole point now is listen, if you have a 401k, all the risk is on you. It's not on the employer. But guess what? I think it was HP, Hewlett Packard. I think it was in 2019 or 20. Check it out. They bought a $5 billion annuity, Dave, for 41,000 employees. Why do you think they did that?
Guaranteed income.
Yeah.
Absolutely.
Right?
Yep.
Now, remember, they want to make sure they're doing the right thing for their workforce, but at the same time, they know that they're not in the business of managing money.
Absolutely.
Right?
Offset the risk.
So you're going to see that more and more. Can you share some thoughts on not only like how people should position themselves, but where life insurance kind of factors into this model?
Absolutely. So I love everything that you just shared, Rob. And, I could not agree with Barry more as well. It's about income distribution. It's about what your assets can produce for you as income and as the replacement for the income that you were accustomed to while you were in your working years, right? Your salary. The challenge with assets that are market-based is they're wonderful for accumulation, right? You get high rate of return. There's no ceiling on rate of return.
Assuming you have a balanced portfolio.
Assuming that you have a balanced portfolio.
To be clear.
Absolutely.
And you're not like trying to change overnight. Go ahead, I'm sorry.
Well, the challenge, but to that point, Rob, people underperform markets every single day, right? That's because fear and greed, but that's a different conversation. Yeah. But if I have assets that are allocated to the market and we have a time like we're experiencing right now, right, where the NASDAQ is down 30%, the S&P is down 24%, and I'm taking, let's say I just owned the S&P 500 ETF, the SPDR.
Yeah.
I had $1 million in that.
Yeah.
And I took a distribution for the first 6 months of the year to fund my income requirement. Yeah. And it pulled back. Well, now I'm hopelessly underwater.
Yeah.
And I'm relying on that how long am I going to live during retirement? I have no idea, Yeah. And so I think the benefit of insurance is that insurance can number one, protect my spend down on the asset that I have. It's a permission slip for me to take that same sum of money and do exactly what Hewlett Packard did, right? Buy my own personal income annuity. Because those are based off interest rates and life expectancies. That's it. You know, I'm trading in assets for guaranteed income for as long as I live. That's
for a certain period. Yeah, exactly. So I think that, you know, we often hear about tax law strategies. And for all you folks that have the benefit of being up, be careful. Talk to your fiduciary that someone's not saying, hey, sell this for a loss so we can put it into something different.
Right.
You know, you can't trade your way out of a market decline. I think somebody said, like, hey, if the market's down 20%, it's going to take 40% to get back to break even, right? Something like that. I don't really know the math on that. But if you pull money out trying to time when to put it back in, you could find yourself losing and going down a rabbit hole that becomes very challenging.
Yes.
You know, so I think for us, you know, the main question is what kind of vehicles to use now, not change, you know, maybe you want to adjust your approach, but what do you want to add into it if you don't have it?
Sure. I think for retirement income distribution, I think you want to add in permanent life insurance. That's number one. Again, permission slip to spend, and or you can leverage that for spending income, right, in the future. But then number two is I think that you want to layer in annuities, right? Contractual guarantees of accumulation, contractual guarantees of income distribution, right? The older that I get, the greater the distribution is to me because my life expectancy is less. But the fact of the matter is that insurance companies are very precise with how they calculate these out. So they know, based off the law of large numbers, how long they're going to have to pay for, right? So they can afford to do so as well, you know?
Yeah, and if you're a business owner, you may want to look into a defined benefit pension plan. Speak to us privately where it's funneled with or funded with fixed annuities and life insurance. Because now you're going to deal in the space of a guaranteed distribution, a defined monthly benefit that's a number that fits with whatever you're looking for, not in replace of, but to complement what you're currently doing. Go ahead and you know, click the link below, set up a time, speak with us. There's no obligation. We're here to serve and contribute. And Dave, if you don't mind, please take us out, brother.
Oh, absolutely. Folks, you know, it's a challenging time economically. It's a challenging time with markets, but there's never been a more important time to focus back in on investment philosophy and have conversations with people who have been there, done that. But folks, link in bio. Myself or one of the team members will get in touch with you. We'll have a conversation. We'll build out for you a financial freedom roadmap, and we'll look at the decisions you made up until now and are they going to best suit you going forward.